Right now, 1 in every 632 homes in America had a foreclosure filing in just the first 6 months of this year. That's not a percentage. That's a specific house on a real street, in a real neighborhood, somewhere near you. And the thing that makes this strange is that almost nobody is talking about it. Adams Mid-Year Foreclosure Report shows 227,548 properties with foreclosure filings in the first 6 months of 2026, up 21% from the same period in 2025 and 28% higher than 2024. Those are the kinds of numbers that should be generating headlines every single day. And yet most people scrolling through their phones right now have no idea this is happening. So this video is about what's actually driving this surge, why it's concentrated in places the mainstream narrative keeps ignoring, and here's the part that almost nobody outside the mortgage industry has figured out yet, why insiders are already forecasting that this gets worse before it gets better, on purpose, as a planned outcome. I've been digging through the industry data on this, and by the end of this video, you'll understand exactly what's building beneath the surface. The last piece of this story is the one that honestly stopped me cold when I found it, so stay with me. Let's start with the part of this that most people are getting wrong. When foreclosure numbers spike, the instinct is to look at the housing market as one big thing. Prices are up, inventory is tight, so it must be fine overall, right? But that framing is exactly what's hiding the real story here. Mortgage delinquencies have increased on an annual basis, with conventional loan delinquencies relatively flat, but with notable increases among FHA and VA loans. That distinction matters enormously, because FHA and VA loans aren't a small corner of the market. They're the loans that first-time buyers and veterans use. They're the backbone of working-class homeownership in this country. FHA loans hit a delinquency rate of 11.52%, the highest level since the second quarter of 2021. Meanwhile, conventional loans, the ones with bigger down payments, higher credit scores, more financial cushion, are basically fine. Conventional loans had a foreclosure inventory rate of just 0.39%, up only 2 basis points on the quarter. So what you're actually looking at is two completely different housing markets operating at the same time. One is stable, the other is cracking, and the one that's cracking is the one that serves the people with the least room for error. Now here's where it gets more specific and more uncomfortable. A mortgage servicing executive has pointed to government-backed mortgages through FHA and VA as the two main drivers of foreclosure activity. And in the VA loan space, the decision to discontinue the Veterans Affairs Servicing Purchase Program has led to more foreclosures, since there was no payment reduction option for these borrowers, while VA was developing a new loss mitigation waterfall. Think about what that actually means. A program existed that let the VA step in and buy delinquent loans from servicers, giving struggling veterans a path to keep their homes. That program ended, and while the government worked on building a replacement, there was a gap. No safety net. Even under the new waterfall released in June of 2026, which isn't even mandatory for servicers until November, there are no expressed payment-lowering options, and practically the only time a veteran borrower may receive a lower modified payment is if their note rate is higher than the modified market rate, which under current conditions will be a very rare event. So veterans aren't losing homes because they made bad financial decisions. They're losing homes because a bureaucratic gap opened up at exactly the wrong time, and there's no mechanism to lower their payments even now. The decision to discontinue the VASP program has led to more foreclosures, since there was no payment reduction option for these borrowers, while VA was developing a new loss mitigation waterfall. That's a direct quote from someone who runs a mortgage servicing company and watches this pipeline every single day. This isn't speculation, it's cause and effect. And this brings me to the part of the picture that really puts the scale of this in focus. Foreclosure starts climbed 18%, and REO completions, full bank repossessions, increased 33%, as average timelines fell to 563 days, the lowest average timeline since 2013. That last number is the one to sit with. Homes aren't just entering foreclosure faster, they're reaching the finish line faster. The pipeline is accelerating at both ends simultaneously. More homes going in and homes coming out the other side as bank-owned properties at the fastest pace in over a decade. That's not a slowdown normalizing. That's a machine that's been turned up. The first quarter's foreclosure inventory rate for FHA loans reached its highest level since the fourth quarter of 2018, and the foreclosure rate for VA loans reached the highest level since the second quarter of 2017. Those are 6- and 9-year highs, respectively, and they're happening right now. And here's the geographic reality that should make this feel even more urgent. Early on, you could look at foreclosure data and say, well, that's a Florida problem, or that's a Rust Belt thing. That framing is no longer accurate. As of a March 2026 report, 77% of U.S. metro areas were experiencing rising foreclosure rates, up from under half of metros just 3 months earlier. What looked like a regional story is quietly becoming a national one. Among states with at least 500 foreclosure filings, Idaho registered a 59% year-over-year increase, closely followed by Colorado at 57%, Georgia at 52%, and North Carolina at 47%. Those aren't distressed legacy markets. Those are states that were doing fine. The spread is real, and it's accelerating. Now I want to talk about something that's been artificially inflating the scariest-looking numbers, because this is actually important context, and getting it wrong leads to bad decisions. Results have been affected by the implementation of required trial payment plans, during which FHA loans are still considered delinquent for survey purposes until a permanent workout is in place. So when you see that 11.52% FHA delinquency rate, some portion of those borrowers are actually in the process of fixing their situation. They're making payments on a trial plan, they're doing everything right. But because of how the federal survey counts these loans, they still show up in the delinquency column until the modification is finalized. That means the headline numbers are somewhat overstated. But here's the flip side of that. Even accounting for the borrowers who are actively recovering, the underlying trend is still clearly moving in the wrong direction. The trial payment plan effect is masking some improvement, but it's not masking a crisis that isn't there. This increase appears to be driven by the length of delinquency, rather than by an uptick in the number of loans becoming newly delinquent. In other words, loans are staying delinquent longer, not just entering delinquency faster. That stickiness matters, because it means the usual escape valves, refinancing, selling, catching up, are working less reliably than they used to. Foreclosure starts are running well above year-ago levels, while prepayment speeds have fallen, as rates have edged higher, meaning fewer distressed homeowners are selling or refinancing their way out before the process gets started. The exits are narrowing. If you're a homeowner, an investor, a real estate professional, or just someone trying to understand what's actually happening in this market, I put together a free guide that walks through exactly what these data points mean for your specific situation. It breaks down the warning signs by loan type, the options still available depending on where you are in the process, and what to watch for over the next 12 months as this plays out. You can grab it in the link below. It's the kind of thing that takes about 20 minutes to read and saves you from being caught off guard. Now, here's the part I told you to wait for. The part that the insiders already know. An industry executive has said explicitly that the increased foreclosures in the FHA space are a correction to more normal activity, that foreclosures throughout the COVID era were artificially suppressed, and that there will be inflated activity over the next 1 to 2 years while that correction occurs. Read that again. Inflated activity over the next 1 to 2 years. That's not a warning. That's a forecast. It's a planned outcome that the people running these pipelines have already priced in. The insiders aren't panicking. They're preparing. They've looked at the data, they've done the math, and they've already told each other that this is going to continue through at least 2027. That's the thing that almost nobody outside the mortgage industry knows right now. And it makes sense when you look at the inventory numbers. Active foreclosure inventory climbed 34% to 280,000 loans as of May 2026, the highest level in 6 years, alongside serious delinquencies up 111,000 year over year. That's a scale of quiet distress that hasn't produced the kind of mainstream alarm you'd expect, partly because it's not 2008, partly because most homeowners still have equity, and partly because the numbers are being smoothed over by language like normalization and returning to typical patterns. And that framing isn't wrong exactly. Foreclosure activity remains relatively low by historical measures, certainly far below the levels seen following the 2008 financial crisis, when the number of foreclosures was 5 to 7 times higher than today. So, no, this isn't a repeat of 2008. The equity picture is different, the lending standards were better, and a wholesale collapse of home prices isn't what this data is pointing to. But not 2008 doesn't mean not a problem. What it actually means is that the distress is concentrated, it's sticky, and it's going to keep building for the next year to 2 years by the industry's own admission. For mortgage servicers and investors, the combination of more starts and shorter timelines means pipelines could move more quickly from delinquency to REO, requiring tighter loss mitigation and disposition strategies. That's the professional translation of what's happening. More homes entering the system, moving through it faster, and coming out the other end as bank-owned properties at a pace that's going to reshape local markets in ways that take time to show up in the headline numbers. So here's where we are. In the first 6 months of 2026, foreclosure filings were recorded on 1 in every 632 homes nationwide. FHA delinquencies are at their highest level in 5 years. VA borrowers are losing homes partly because a program was discontinued before its replacement was ready. REO completions are up 33%, and foreclosure timelines have fallen to their lowest point since 2013. And the people who run the mortgage servicing industry are already telling each other to expect elevated activity for the next 1 to 2 years. At the start of this video, this looked like a scattered set of data points. What it actually is a single coherent story. A specific, identifiable segment of the market is under real stress, the safety nets have been reduced or eliminated, and the pipeline is moving faster than it has in over a decade. That's the silent wave. It's not crashing, it's building. And the question worth asking right now is whether you're positioned to see it clearly before it reaches you. Grab the guide in the description. It's specific, and it'll walk you through exactly what to watch. And if you want to understand the broader forces shaping the housing market right now, the next video covers what's happening on the supply side that most people are completely misreading. That one's worth watching back to back with this.